Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. And the last 45 odd days have seen the possible withdrawal of money that went into China, lock, stock, barrel at the start of the calendar into other Asian markets. The Chinese gauge has dropped 20% from its recent highs, and the flows into India and presumably some of the other countries can probably be testimony to the point that I was just making. Now, flows are one part. What are the fundamentals telling, and what is the global picture looking like, and Asia and EMs within that? I know of no better guest than Mark Matthews to put all of this into perspective, and it's my pleasure to talk to him today on Talking Point. Mark, great having you. Thanks for taking the time out.
Oh, Neeraj, don't say that about me. That's not true, but I'm honored to be here. Thank you.
Thank you. Well, I mean it. Mark, I would love to understand from you, what do you think of the last 60 odd days? Because much as there was China fanfare with the slowing economy, the markets came off, money seems to have retreated and come into multiple markets, including India.
Yes, I think that we've had a breakout globally in stock markets. There were some stealth outperformers before this breakout, like Europe. But when we saw the S&P cross above 4,200 on the index last week, then that was a clear breakout from the previous resistance. And I think that, there's lots of reasons why the market could go higher. Right now, we all know it's being driven by a tiny handful of mega cap technology stocks that are plays on artificial intelligence. But one thing that interested me in the first quarter results of the S&P 500 companies was the number of companies mentioning both the words inflation and recession on their conference calls with analysts, going down very quickly. It went down very quickly in the first quarter relative to the fourth quarter last year. So that whole story about how we were going to tip into a recession and inflation is going to remain high, I just feel that it's ebbing away. And as it does, there is, I think, increased confidence that earnings will surprise on the upside for the remainder of this year. And of course, ultimately, what does drive share prices is earnings.
Yeah, and if those earnings are accompanied by a narrative of not higher rates or maybe lower rates, then that could be icing on the cake. I'm just trying to understand, Mark Matthews, are you constructive on risk assets for the remainder of the year, or having rallied thus far, you believe that the risk reward is evenly balanced or maybe even poised towards the downside?
Well, we're not expecting a rate cut until January of next year. So we're looking at, several months of rather high interest rates, but we're also pleasantly surprised at the economy's ability and the market's ability to withstand these high rates. Apparently they are. I would say that the maturity of the debt of the average S&P 500 company is quite long. It's about 7 years on average. So they're not all being hit with higher financing costs now. And we are constructive. So what I would say is that the S&P, you may recall, peaked in January of last year, and then we had a bear market, didn't we? And we fell until October. I think peak to trough was 25%. So it was a bear market. Since then, we've retraced a little more than 50% of last year's bear market decline. Now, if you look back in previous episodes, when the S&P recouped 50% of the bear market loss, and look at what happened after that. Just to keep it simple, looking out 12 months after you recouped 50% of the bear market loss, the S&P was up in all instances. And the return on average was a very healthy, as I recall, 19%. So that's an average, so it wouldn't always be that. But I think the important thing to say is that it was never down 12 months forward once it had recouped the 50% loss from the previous year's bear market.
Okay. Well, We look forward to such things getting repeated as well, Mark. One school of thought, Mark, and Russell Napier kind of spoke about it as well, is that the governments have no choice but to keep inflation. I mean, will not combat inflation because there is no choice but to inflate their way out of the massive debt piles that they are sitting on. Now, do you subscribe to that? And if so, would higher than the previous decade interest rates still mean that markets will follow earnings and therefore move higher, or could higher for longer interest rates play spoil sport?
Well, there's sort of different questions in the sense that one's about the government debt and the other's about the market. I don't think they're really related. But I would say that a Fed funds rate at about 5% is, I know it sounds incredibly high. It is rather high. It's actually something that the market has lived perfectly well with for many, many years. I think we forget because, we were living in this la-la land of zero interest rates for the last 10 years, that interest rates are supposed to be, at about 5%. I mean, maybe not quite as high as that, but you can look back through many episodes in the 80s and 90s and 2000s when we had interest rates at around 5%, and the market did perfectly fine. So the private sector in the US is not heavily indebted, and that's a key saving grace. The government has a lot of debt, but my sense is that is not going to be a direct catalyst for the market performance. And the government's ability to finance the debt at a 5% Fed funds rate you would think constrain the ability raising debt levels a lot more, and perhaps it will, because I just saw that interest expenses for the U.S. federal government are on the verge of surpassing their total defense expenditure for the first time ever. So I think in a way it might act as a constraint on government spending. And obviously, I think that's already being seen in these negotiations that they're having in Congress over the debt ceiling. But anyway, I don't want to ramble. Long story short is I wouldn't think that high government debt levels are what's going to take the stock market down.
Okay, yeah. What I was trying to think that if the debt levels are high, and if indeed Russell Napier's theory of governments having to inflate their way out of this debt situation would therefore mean that interest rates stay higher and therefore they have an impact on markets. That's the correlation that I was trying to drive. But point well taken, Mark. And now I'm trying to kind of bring back my first question to the thesis that you posted for US markets, or the mother market thus far, which is that if the US markets shape up the way you are saying they might, and if the recency of withdrawal of money from China into other markets continues, and if we see the upticks that we've seen, for example, in the Indian markets, which are up 2,000 points from the lows of 16,800, do you reckon that there is more in store for EMs and markets like India?
The EMs are really not participating in this big bull market this year. It's a very tech-centric bull market, and with the exceptions of Taiwan and Korea, which are officially EMs, although I don't think they really are EMs, but they're still in the MSCI Emerging Market Index. That, apart from them, emerging markets are not big participants in this rally because we don't have technology stocks really that dominate the indices the way they do in the S&P or in the Nikkei or Taiwan or Korea. So I'm not quite sure what would put EMs back on the radar screen. They might not come back for a while. I would say what's interesting is that there was a theory around 6 months ago that the reluctance of people to put much money into China would benefit India. And what we're seeing clearly is that it didn't hurt India, but it didn't help that much either. And the market it really has helped is Japan. So people have decided that looking for exposure globally, the place in Asia they'd like to be is in Japan. And I think that the planets are just very nicely positioned for Japan now. There's about 5 or 6 or 7 quite compelling arguments to that market continuing to rise. So I suppose that it's actually taken focus away from the other markets in Asia that we thought would naturally get attention due to China's, sort of being a place people don't want to invest in.
Okay, point well taken. And I buy your argument that EMs, like I'm just looking at India, citing India as an example. YTD is just up 2.45%. But Mark, from the lows, we've seen from the lows of 16,800 about a month and a half back, we've seen a sharp pullback in Indian markets as well. And we've seen serious money coming back after a serious bout of withdrawal. So I'm saying if I don't look at YTD, but look at quarter to date, then India has been the best performing market, arguably in the Asia EM pack, if I'm not wrong, maybe ex-Japan. So, and therefore my question, do you reckon that momentum can continue? Sure, YTD numbers may not look impressive, but quarter to date, it's been an impressive run. Can that continue for India, for some of the other markets?
I mean, I think it should. I like the Indian market, but I'm not sure it will, because I must say, just anecdotally, based on my own discussions with investors, they like listening to the Indian story, but I see very little follow through. They maybe after the roller coaster of the last few years with COVID and Ukraine and markets just up and down like a yo-yo, you want to be feeling, well, at least I know what's Nintendo, what's Sony. Like, these are big brands. I grew up with them. And India, chances are you might not even have visited the country. So it's a much bigger leap of faith, even if the story is a compelling one, as we all know. But people, unless they're feeling quite confident, are usually reluctant to commit capital to something they don't really know very much, or they've never seen firsthand. So I'd like it to keep going up, but I'm not sure it will. I mean, what I would also share anecdotally is that I think where there's a lot more interest in India is more on the foreign direct investment side. There's a lot of multinational companies, as you may know, visiting India, scouting out India, and figuring out how can we come into India. And to my mind, the most important thing for India actually will be what Apple does. And if Apple really does what they say they're going to do, that'll put India on the map in a way that'll make it unavoidable. To take the production of iPhones from 2 million units to 25 million units, for example, over the next 5 years. They really do that. And of course, it would require creating a big ecosystem in India. That I think would be totally redefining the perception that people have globally toward India. But it hasn't happened. It might happen. That's what I'd look forward to.
Okay. So, Mark, I'm just trying to understand. We spoke in the beginning of March, and at that point of time, you had the view that India is the best Asian market to invest in. Do you, independent of what your investors might be telling you, do you still believe that to be the case? And part two, would it be an Apple-defining moment, or could it be growth within India in the run-up to the elections or otherwise, which might make more investors come in? Because I buy your argument that a lot of people wouldn't have come to India, but the flows, Mark, in the last 30 to 45 days, northwards of $4 or $5 billion, have been pretty heartening.
Well, I hope they continue. But I'm just saying, in my own modest universe, I'm not seeing it. So I'm glad somebody's buying it, but it's nobody I know.
Okay. And then your view.
To answer your question on the Asian markets, my sense is the best Asian market this year will continue to be Japan. So I wasn't correct when I told you back in March that India would be the best. I think it will continue to rise. India won't do badly, but I don't think it'll do as well as Japan.
I get your point. Mark, the last question or two, and one of them is on how worried are you about the ongoing US-China spat? Because it has its ebbs and flows, but there are more negative news flow as opposed to positive news flow when it comes to the relationship between the two. And it might have a bearing on what happens to world growth as well in some fashion, as well as countries having to take sides if it comes to that. How worried are you about the US-China spat?
Very worried about it. And I think you summarized it very succinctly that there's more bad news than good news. So there was an attempt by the Americans to say, well, we're going to try to make the relationship better after the G7 meeting, and that didn't work, did it? And I just saw that China's defense minister has declined an invitation to meet the U.S. defense secretary, so no, it's not looking good. But I suppose what I would say is that it certainly hasn't stopped markets from doing well, and I don't think it will unless we get an actual breakout in hostilities, and that's not something that I foresee. But I also think that it's not really something that can be predicted with any great degree of accuracy. I love to use the analogy of the Russian Revolution in 1917, when in the lead up to that, it was a big Russian bond market in Europe, and people were just so shocked at the idea that there could be a communist revolution that they never imbued it in bond prices. They just thought, well, it's impossible. Of course, it couldn't happen, and it did. And it really took the actual revolution itself to happen before the whole bond market froze up and eventually disappeared. And so I guess what I'm trying to say is that the geopolitics don't really matter. Geopolitics don't really matter until they're the only thing that matters. And hopefully that's not going to happen anytime soon, but certainly not nice to see the deterioration in the relationship of such important countries.
Got it. Mark, my final question. And there is a lot of chatter around de-dollarization. Now, that's a too wide a topic, but what I want to get your thoughts on is this. There is this talk of how not just India, but a few other countries might do, and which are oil importing, might try to get the trade done in the local currency instead of a dollar import. And what that could do to their current account deficits, the change in the current account deficits, if that were to turn out with Russia and eventually maybe with OPEC as well. Now, India is already talking of becoming current account neutral to surplus, even without this possibility, I presume, in the next 2 years because of electronic exports, software exports, etc. But if this were also to happen, does it make some economies like India a lot more structural as opposed to being cyclical the way they have been in the past 20 years?
Off the top of my head, I don't have a good answer, but I agree with you that the current account in India is becoming much more favorable, and already it's 1.4% of GDP, incredibly low. So, and that will continue to narrow as you rightly point out, exports go up the value-added ladder. The issue with de-dollarization that I have is that. I don't know, say, for example, China and Brazil decide to trade based on their own currencies, and Brazil, sort of buys a lot of things from China and takes renminbi. What are they going to do with that renminbi? I mean, how do you invest it? Do you just keep it in a bank account? I don't think so. Do you buy Chinese bonds, which are extremely intransparent, no real solid credit rating system to speak of, and not an open capital account? You're quite vulnerable to, the whims of the government.
No, what about? Sorry, I'm interjecting, but what about, say, a possible India-Russia trade, wherein Russia gets rupees, Russia can invest that back in India infrastructure projects, or Indian bonds, which, well, for lack of a better word, are not comparable to the Chinese bond market?
Yeah, I mean, maybe theoretically, I won't say no,
Okay.
but I also really wondered, do Russian companies want to have lots of rupee exposure?
Sure.
Maybe they'll be fine with that. And I think actually you do hit on a salient point, because the rupee, as you know, has been a very solid, just flat currency. And I think that's intentional. The RBI is trying to prove that it's a currency that you can trust and doesn't have too much volatility, precisely for this goal to try to international the rupee more. I hope it happens, but I still struggle to see why. I struggle to see the appetite for really owning lots of rupees or reals on the part of other countries. I suppose you're right; they could invest in infrastructure in India. It just strikes me as something a little bit odd.
Got it. Fair call. Lovely talking to you, and thank you for your frank opinion as always, Mark Matthews, and thanks for your time.
Thank you, Niraj. I really enjoyed it.
Likewise, and viewers, thank you for tuning into this edition of The Talking Point.